tell the audience about how you got started in real estate. Cool. Well, Brandon, welcome to the show. Excited to have you.
Thank you.
So I want to start off, family offices are kind of like the holy grail of capital from like a sponsor's perspective, but you're not just doing real estate, obviously. Blue Diamond has a huge portfolio. And so I was curious, if I brought you a solid real estate deal and a solid business deal, does one get you more excited than the other?
For me personally, the operating company deal will get me more excited. The real estate deal would maybe have a better chance of getting done. How about that? In typical times.
Is there a reason for, I guess, both of those answers, why you like one more than the other, and then also why it has a better chance of getting funded?
Yeah. Typically, when people ask, tell us about your big wins and big losses, it's on operating companies. So that's where if you're trying to hit a home run, it's through an operating company. So that's where, real cash flows are coming through on a consistent basis. Enterprise value is growing, so the big exit comes. That's where you really hit the home run on the exit and the cash. Where a real estate deal, lower risk, with a tangible item. Depending on it, if you're doing development, you talk about this a lot actually on your posts. So you're taking on risk of entitlement, development risk, build costs, delays. But generally speaking, there's lower risk there on the whole that's going to become something that performs.
Mm-hmm.
And our bread and butter, I say a better chance of getting done because our bread and butter has been real estate deals. Even our operating companies have some type of real estate component, construction, home building, those type of things. So, I'm excited about both, but they sit in different buckets in my mind for sure.
Do you know why you guys have graduated, or not graduated, but kind of done more allocation to real estate in general? Is there like any background on there that makes it more enticing, or is it just you've been doing it and it's worked well and you like doing it?
Good question. I think that's a little bit before my time. I've been around Blue Diamond 10 years, and it started in 2007. And I think they a little bit fell into it they had some land holdings that they had even before Blue Diamond really started, and kind of got into it, went through the Great Recession, found some builders and realized homes were still selling. Raw land was not selling, but people needed homes. And that was kind of you talked to Steve Maddox a couple of weeks ago. So the genesis of Edge Homes was that relationship. And so, but any family office or any wealthy individuals I've spoken to or had a relationship with, a good place to deploy some of your money. I just mentioned earlier, it's perceived to be less risky. Now, there's still lessons to learn in real estate, but most people will put some of their, once you've established this lake of wealth, you're operating a business that's more like a river, the money's flowing. You establish a lake, you're trying to preserve it. You still want to create a new little river, side rivers that will keep some money flow going. Well, generally that's real estate, right? Collecting rents, doing development, those type of things, hotels. So I think that's just a baseline for almost any investor when they have money. It's a tangible item. They understand the concept of what it is, and so you follow that way.
How do you think about the portfolio allocation today? Because obviously it's a big portfolio. Mark said that he lives on like $200 a week, so he doesn't need to make a lot more money. But like, is it kind of keep the money and make sure you don't lose it, or is it, aggressive? Is it impact investing? Like, what is kind of the portfolio allocation mindset today?
Great question. We'll get you behind the curtain a little bit. A chunk of our profits every year goes into the Mark and Deborah Bingham Foundation. So that goes into their foundation and gets donated.
And it gets donated to wildlife conservation, education, and healthcare?
Yeah, those are the three targets. So every year through their website, there's a lot of applications for consideration. We have a board of directors. They meet, decide on how much money we have to donate, and make those allocations and donations every year. So we're still focused on profit and growth, but a chunk of it, goes over to the foundation. And that'll happen in perpetuity. So kind of my day-to-day mandate is still grow the company, make a profit, grow the net worth overall.
Mark talks a lot about net worth.
Yeah.
Yeah.
That's something I realized over working for him and working with any and exposure to any wealthy individual. What they care about is net worth. Nobody's bragging about their annual salary when they're worth real money.
Yeah.
They're talking about their net worth. And so it really is about building your balance sheet and letting those different streams, like I was talking about, kind of pay your day-to-day operating expenses, right? And you get to decide what those are. For Mark, it's very low, yeah.
Yeah. It's the hurdle rate is very low.
Yeah, they live an extremely simple lifestyle for their net worth, and you'd never know. But so, props to them, because that just allows us to have a bigger chunk to donate every year.
That's awesome. You mentioned the balance sheet, and I want to talk about, we've had some conversations about, everybody wants to go buy a company that's making, call it $1 million a year. They buy it for 5 million, or portions of it at a $5 million valuation, and they get those $1 million earnings to, call it 20 million, and they sell it for 200 million or something like that. But they never really go into how that actually works. And I think the balance sheet component of what Blue Diamond can offer to the specifically real estate companies. Let's just talk about what Blue Diamond Capital does when they go buy a company, kind of the life cycle.
Okay.
That was a loaded question.
That was. Let me think through it a little bit.
So I guess let's start with kind of how you find a deal. We'll say it's like a home building company or something.
Most deals are inbound. Most deals are relationship type deals that are inbound relationships. I'll walk you through a couple. You're familiar with Edge Homes, and the CFO of Edge Homes was named Mark Lords, and he's a great guy. And he was running some type of council, like a 20 group, something like that. And so he was meeting with other home builders from all over the country, and they were kind of collaborating and commiserating different strategies and best practices. Well, after the Edge Homes exit for us, he's the one that introduced us to the Visionary Homes guys, Jeff and Justin. And I'll come back to them in just a minute. But he also ended up introducing us to another guy, John Hastings in Boise. So we ended up doing a deal with him on the home builder in Boise. And then we're actually part of a third home builder in Nashville that just this year. And that was introduced to us just naturally through a different relationship that said, hey, I know you guys do home builders or have experience in home building. Can you look at this deal? And so a lot of those introductions come just inbound and through natural relationships. So how does the deal cycle flow? For whatever reason they need money, right? And
can we actually dig into that? Like why these companies need money?
Great question. So that's where I was headed on the balance sheet type thing. As you're earning funds, you're trying to do as big of a deal as you can handle. And
yes.
Right?
That's me.
That's you.
Yeah. And
so you may only have, and I'm not speaking about you specifically, I'm just saying in general, you may have $200,000 total to your name. You may have $1 million total to your name. That is the limit that you can lay out there on the line and go execute on. And you might have to put that money out there for a while and, just kind of struggle by on your daily expenses and stuff. And so trying to grow your business, especially if you may have a lot of revenue or desired revenue coming in. Plenty of people are willing to do deals with you, but you don't have the capital to go execute on the deal. So you're not going to be able to get that revenue because you don't have enough resources. You can't pay the employees, or you can't put down the equity required on a real estate deal. You can't get the financing. The bank's looking at you saying, that's great that all these people want to do deals with you, but you don't have enough underlying assets that if things go bad, we can recover.
I feel like I'm talking to my therapist right now.
So a lot of people end up reaching a cap and saying, okay, this is what my business is. And you made a great example. I'm running a business that, let's say has, $5 million of revenue and $1 million of income, and I could sell it for a 5X, and, I could clear out $5 million and walk. To go take on the scalability component, I'll need help. And it's a lot of work too. So you kind of have to make the decision as an entrepreneur or a founder. I believe, all right, am I happy with what I'm doing now? Because I got to tell you, if you're running a $5 million net income business, that's pretty dang good lifestyle.
Not a bad life.
Not a bad life. That's a great life.
Yeah.
That's, boats and vacations and everything else. And quite a lot of people, we will refer that internally as a lifestyle business. And quite a lot of people have great lifestyle businesses and make great money. There are certain components of people, obviously Mark Bingham's one of them, that want to scale and go for the next level. And again, it takes actually a ton of work. So great that you can go get the money, but or the backing, but it takes a ton of work too. So, to go to the Visionary example, we're talking to the founders, and they have a great business. They're very strong. They're a major player up north.
What year was this, by the
This
way?
is in 2019.
Okay.
So we sold Edge in 2017. That was the year of the exit of Edge. By the end of 2017, we'd been introduced to them, and I think we did one like minor land deal maybe in early 2018 before we actually like built a partnership and joined with them. So what ends up happening is basically, they've reached the limit of how quickly they can grow or how quickly or how much they can scale based on their own resources. And it's not that they can't continue growing, but the pace of that growth would be slow. And, there's still significant hurdles to overcome, and they're carrying all the risk. So you have to identify a new partner that has capital, say, hey, we can come in and break through those barriers for you. Suddenly, we can go talk to the banks, increase your lines, right? We have the balance sheet power to come in and help you, infuse cash into the business so you can go hire more resources. Suddenly, these revenue opportunities that you just couldn't deliver on before are now available. And that's probably the key factor for any of these growing businesses. And that's not just exclusive to real estate, but that's a good example. And so, it's two ways. Again, I made the example of this founder is deciding, right, I'm living a great life. Do I want to go through all this pain and work? And another key factor is, do I want to give up some of my control, right? Like I'm going to have another person I'm reporting to now, but my pie will be significantly bigger in the future if I can execute. Mm-hmm. And so, you put that trust into each other. Suddenly you go execute, and that, helps the company explode and scale. And suddenly your net worth is worth a lot more. Now, generally that's just on paper until the true day of exit or something when you make a liquidity event. But that's the process it goes through. And I'm glossing over all the hard work that happens along the way and some of the timing, right, of the right environment and the right market. But that's what happens is the bigger group comes in and establishes a new baseline of what you can do. And so when you're looking at deals and opportunities to buy more land and develop and create more houses, you have the resources, you have the bank backing, and all those things help fuel you and push you through the ceiling that you had before, based on your own resources.
And I can't remember which company, and if this is not appropriate, we can edit this out, but I can't remember which company it was, but you mentioned kind of how your balance sheet or Blue Diamond Capital's balance sheet will come in and it actually changes the way that they structure their financing on these deals. Like whatever home builder it was, they would just go buy a piece of land through an SPV and then get a credit union and then actually sell the lots to the homeowners, and then the homeowners would hire them as contractors. Mm-hmm. But you guys suggest a different way. Can we talk about that?
Sure. Yeah, there's pros and cons to any type of financing. I'll give you a couple examples actually of how I've seen financing. One is that, hey, smaller builders will typically have the homeowner, buy the lot from them, and now they own the land and they just engage in a contract with them. And what I see actually frequently is like a fee build. Hey, here's the cost of your home. You're about to go build a $500,000 home. I'm going to charge you $20,000 to build it. And then each draw, I'm taking a little bit of money. Yeah, right. Well, that's earning a living, earning a wage, and you're just charging a fee to. But the flip side of that is the customer in that scenario is in complete control of the draws. If they're unhappy with,
the tile,
a scratch in the tile, they can hold up your whole draw, and suddenly you're having a payment problem to your subcontractors. But it allows you to go do the project. If you don't have your own capital to build the home or to build the spec home, then it allows you to do the project and allows you to get pretty sizable, where you're the one finding the lots, developing them, or sourcing whatever and finding the customers to come buy it. That's how you could do some financing, and there's several builders that do it that way. I've seen another way where they basically buy a package of lots with a JV group. Similar idea. They're saying, hey, we're going to give you the profits of the home, the margin, and we're just going to charge a fee. And so every month on they're building out a whole community, and basically every month on the monthly draw, kind of like a general contractor, commercial contractor, they're charging a fee to go build the project, but the profits of the project would go to the investors. What we have done is come in and say, hey, we'll use our balance sheet to help you get what's called non-recourse financing, right? Almost all these deals are recourse financing. So if the customer has the loan, they're on the hook for the loan personally. Or if the builders have the loans, usually they have recourse and they're on the hook personally to make sure that loan performs. The bank can go after them in their personal assets. And we certainly have some of those loans too. Mark and Debbie have some of those loans where they're the guarantors, and if a deal goes bad, we have to work through it with the bank. So that's kind of a side comment. But we try to get to
talk
that.
about that later.
Okay.
Yeah.
We'll try to get that. We obviously come into in the home building example, we want to get into non-recourse financing, which means the bank can come in and if things went bad, they can come in and seize the assets of the company, and we'll make sure we maintain the proper ratios and credit covenants within the company. And they can also obviously take over the land and the homes and whatever, but they can't come after assets beyond that, beyond the company. So if you've performed everything beyond fraud, you can't do any of that bad stuff. It's called bad boy carve-outs.
Bad boy carve-outs, yep.
Yeah, you perform fraud, they can always come after you. So don't do that. But
It's good advice. only the finest advice here.
that's right. That's right.
And is the reason that you go non-recourse, is it strictly a risk thing, or are you creating enterprise value for the next guy? Like, how do you think about that?
Yeah, I think it's both. Primarily risk mitigation. When you start building a large portfolio from our view of different assets and holdings, there's not really a reason that hotel in, Alaska should be exposed to a home builder in Utah, right? Mm-hmm. Those should be separate things and separate ideals. So you try to create these buckets where your risk is isolated on your exposure of your different assets. And certainly if you can get it down to within just the actual company. But then to your point too, if you're doing a transfer or some sale or liquidity event, generally speaking, the group buying, coming in with to buy is going to have their own facilities and lines, but they may be interested in exploring using the same banks and financing that you've been using. And certainly if it's non-recourse, that makes it easier to transfer.
How much do you think like the balance sheet impacts like relationship banking? Because every banker that I've ever talked to says like relationship banking, blah, 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 but it's basically the same terms at the end of the day. I don't know. You guys have a lot more money than I do. How big of a dent does it make?
Wow, I think it makes a huge dent. Now, my only experience there is with Blue Diamond, so other than I guess my personal personal sandwich, I'll go to this. When we were in COVID, all of the hotels across our portfolio shut down, right? And obviously, everybody that I could call that was a local bank or that was a bank that had a bank officer and I knew them, it was a pretty easy process to get through. We called them, we let them know, hey, here's where we're at, here's where our balance sheet still is, here's where our liquidity still is. We're going to go through a few months here of pain, ride this with us. And we were pretty proactive on proposals. Hey, can we, we're looking for a 3-month interest only instead of a normal amortizing payment or a 3-month deferment, whatever. All of those conversations went super smooth, no problem. And on a lot of our hairy deals, when we encounter deals that are problematic, if the bank knows at the end of the day we can continue to perform, those conversations go very smooth. And we, in a way, have some leverage to propose, unique terms or unique payment structures that likely other groups, and certainly someone that couldn't perform, isn't going to get, right? Even if it's the best interest of the bank, I've seen it several times where the bank makes a confusing decision, right? They just kind of get their pressure from the higher ups of, I guess I got to foreclose, even though another way would clearly be the better option. So, the relationships matter. Going back to COVID, when we were dealing with CMBS loans, which are commercial mortgage-backed securities loans, these big, conglomerate loans in the stock market, you were never talking to someone that could make a decision. I'm calling some asset manager in the special servicing department, and they don't know, and there was no relationship, and they kind of don't know and don't care. So those were extremely difficult to navigate during COVID, where relationships were very easy to navigate. So that's what I'll say.
Did you make any progress on the CMBS stuff in COVID?
During COVID, no. Luckily, knock on wood, luckily, holy cow, when I think about it, we had a couple hotels that were fine during COVID, believe it or not. And so they were able to stay open. We never missed debt service. I think on one or two we had nominal capital calls. We had infused a little bit of cash to keep the debt service going, but we kind of survived.
Pretty good given the circumstances.
Yeah. So, certainly in that situation, it worked out to our advantage. I've had a couple others, I always like to give the qualifier that, hey, we win more than we lose, but I'm not scared to talk about the fact that we've had a few losers here and there.
Yeah.
So we win way more than we lose, but we certainly have to go through some workouts and some problems. And on those, the experience with CMBS has not been fun. Not responsive. It's been a real grind to get to the point where they'll even make a decision. How about that? Yeah.
I wonder if there's any venture capital solving all these weird problems. If you're a venture capital investor, you should solve that problem. You should disrupt CMBS loans. Going back, so you're the CFO of Blue Diamond. What does a CFO even do? Like, what does your day to day look like?
Great question. I should probably change my title at this point. So I'll start with what a CFO in my mind typically does, and then maybe what I'm doing in my current role. In my mind, a CFO is someone who is handling the financing strategy of the company. So if you're an operating business or investment business, either way, you are reviewing the cash flows of the company, the cash forecast and strategy. Do we have enough revenues coming in to cover expenses? And how are we going to utilize resources to cover those expenses? If you're a growing business, you need cash. We talked about this earlier. Hey, you're trying to push through your ceiling. You're going to need resources to be able to deliver on those new opportunities. That's either through debt or equity if your margin is not sufficient or your cash flows are not fast enough to allow you to do it just through increased sales. So as a CFO, you're on a strategic level analyzing all of those things and trying to push them forward and deliver on them and go execute the relationships. You're either part of the equity raise. Now, the CEO is the face of the company, so that's probably the marketing person that's really there raising funds on an equity raise, but I think the CFO has to be there to answer the questions and deliver on the strategy. And, the CFO is not usually the people person to the extreme, but can be. And then again, executing on those relationships with financing partners to make sure the cash flows of the business and the finances and accounting are all running.
So you are looking at just this company, and you see, hey, we're going to run out of money in 3 months or whatever, and we're not going to get paid until month 5.
Yeah.
How do you solve that problem? Like what are some of the tools in the tool belt, I guess?
It's a great question. I have a project right now, and I just had a call last Friday with a bunch of investors about this exact situation. Saying, hey, we're going to run out of cash in a few months on a project that's a little bit stalled. And, I told them, hey, real estate, this is a quote from my old BYU teacher, Stan Ricks. Real estate is like swimming across Utah Lake with a pack of gold on your back. You might drown along the way, but if you can make it to the other side, you'll be okay. And right now, we're in the middle of the lake. And so, it's like, hey, this is where it's going to get us. This is what has bought us so far. I can go get debt. And, luckily, we're in a position where I'm very confident we could go approach a bank, get a construction loan, and kind of keep the project going. You can find a way to increase sales, like a discount, right? I could discount the sales price and just take the cash, maybe not make a lot of profit, or severely hamper my profits, even down to zero if I needed to, and probably generate some cash that way, or I can raise some additional equity. And so you put those options on the table, and those are your options, in my opinion. Like, you got to get it some way. Debt and borrowing entails a whole smattering of options. So you talk about tools in the tool belt. There's quite a lot of different borrowing structures.
Those are all of my tools. It's
there you
just
go.
More debt. They're all hammers.
So that is a wide swath when I say that. But you approach the investor group, say, hey, do you want to add on to the investment here? And if so, here's the proposed terms. And I like it when, I guess for myself, I try to have a game plan going in. Here's what I propose to do. If I get a bunch of feedback like we don't want to do that, then I'll go a different route, right? If the investor group last Friday had said, oh, no, we're not doing that, I would have said, all right, well, I'm going to discount the product until I make enough sales to get the cash we need. So the key thing that you brought up is being ahead of it. That's definitely a role of a CFO. You got to be ahead of it. You got to be sounding the alarm a little bit early. You can't wake up one day and be like, oh, we bounced a check yesterday. What are we going to do? That is no good.
I've never been in that situation for anyone asking.
Good.
Okay, so this is kind of a technical question, and it doesn't have to pertain to this deal. But let's say I'm building apartments or something like that, and I need to come up with $10 million. Do you suggest forming that in like a second mezzanine position or like a second loan, or like what is your preferred vehicle of financing, or do you think it's like diluting equity? Like what's option number 1 for you?
Are you saying coming up with like a shortage of $10 million?
Yeah.
Okay. Of course, the answer is it depends.
Yeah.
But usually, equity is the most expensive item, but it has the easiest payment terms, which usually are no payments until cash is available to pay.
Yep.
And so there's a balance there on that particular piece. So I'll back up again to this example project that I'm talking about. We're in it for all cash. That's been a huge boon.
Really?
To this project for me, because as it slowed down, the market completely turned in this past year, and so we haven't generated the sales quite yet that we were expecting. But I don't have a debt payment hanging over me, It's like, hey, we can just stop. We can wait. It's going to dilute our IRR, time value money, that counts. But we can just stop and just sit here for a while if you want.
You're in a
Or,
much better position than you
well,
made
that's
it
just
sound.
on one
Yeah.
project. We
So,
have other
yeah.
projects that
Yep.
have debt.
Yep.
And so, what's the market telling you? If the market's still hot and you just run into a nominal overage on an apartment development or something, and you can go to the bank and say, hey, can we up our construction loan by this $1 million or something? Something. You're saying 10. That's a pretty sizable
Yeah.
project, but just as an example, in a good market and you're pre-leasing, everything's going well, I would probably take the debt. We're going to
Okay.
cover it easy. It's a lot lower than giving up equity. But if you're in a different style of project or your outlook is a little bit different and you need some type of long-term patient capital, I'd probably go with the equity side and say, okay, well, I need to be in this for the long haul. I need something patient. I don't need a payment hanging over me. You can tell, especially in right now, this current environment, if you are not well capitalized and you're involved in a project and it's getting stretched, you're going to have to fire sell, right? You're getting desperate. You're going to have to discount compared to my example project. We're just kind of hanging out, and hanging out's not the right word. I'm trying to pull as many creative angles as I can, but there's no payment hanging over, and that really is a life preserver while you're out in the
That
middle of the
is.
lake,
Yep.
right? To say, okay, hey, we can hang out here for a minute. We're not drowning. We're not getting across the lake like we want. It's a little bit slower progress, but we're okay.
Yeah, I think a lot of people discount, everybody says you make all the money when you buy. You also make a lot of money when you don't have to sell. Forced
Yes.
sellers are the worst situation you can possibly put yourself in. So little note to the audience on that. What is how does one become a CFO? It's typically accounting background. What is your background?
Yeah, I'm a CPA. I graduated from BYU with a master in accounting and did Big Four public accounting at KPMG out of school. That's my background. After KPMG, I went to a company called backcountry.com. It's up in Park City. And they're an online e-tailer of outdoor gear. For anybody that hasn't looked them up, they're an awesome company. Go look them up. And so from there, I was there for 3 years. And while I was there, we did 2 acquisitions. And we actually built an East Coast warehouse. And as part of the construction, I didn't realize that at the time
really?
that that'd be part of my future, but I was the kind of the quote unquote project manager on the accounting side for the construction draws and the budget and all that type of stuff. Kind of a fun experience. And then I came to Blue Diamond. So those are my 3 jobs post graduating school. I've been at Blue Diamond for 10 years.
How long did you survive the Big Four accounting?
I was there for 3 years, just under 3 years, but I did 3 what they call busy seasons. And a guy that had been at KPMG with me had left at the backcountry and called me up and was like, hey, I want you to come work for me. And I loved it. It was very heavy hours.
Really?
I loved it. I was not on the hunt at all. I was not looking for a job. If you would ask me the day before that guy called me, I'd have been like, I'm working here until I'm a partner. I'm never quitting.
Wow.
And he really put the pressure on me to come work for him. And it was great. I had a great experience and it worked out awesome. And he was a stud and I'm very grateful. But so that's my experience. I've kept my CPA license up and I think most people stay, 3 to 5 years in public accounting. So you don't have to be an accountant to be a CFO. There's plenty of finance background people. Again, people that understand debt structures, capital raises, all that type of stuff, deployment of cash. So that's not the only route. I think that's a route of becoming a CFO, but certainly the finance side, anybody that understands money and numbers and financial strategy, just depending on their opportunity, right?
You kind of glanced over the difficulty of working at a Big Four accounting firm. I just want to note that is a grueling job, and that's impressive that you had such a positive outlook on it.
Oh, you know what? The thing I loved, and this is what I love about Blue Diamond, you're never bored. You are always moving on to new clients. And so, sometimes in my mind, I'm like, I'll admit that I think of like a specific company and I'm like, oh, well, how would it be to just worry about that one company or that one thing?
Boring.
And it wouldn't be boring. It would actually be cool because you have new initiatives. But I did love going on to new clients. And so, okay, I'm doing this client for a few months. Now I'm on to the next one, and the next one, seeing new things. It was super busy. You do work very grueling hours. And so that's just part of it, I guess. And
So speaking of exciting, I think you could describe the Blue Diamond portfolio today as very exciting. You guys are in real estate, operating companies. You've also done some venture stuff. Can you talk about what the portfolio looks like today as far as kind of industries you do like and industries you don't like?
yeah, good question. Still like real estate industry. I'd say 70% of our portfolio-ish is real estate-based investments, hotels, apartments. Uh, Now, again, we've talked about home building. Home building is an operating company. It's real estate-based,
Yep.
but it's an operating company. So, if I put those in the operating bucket, we're involved in construction, Rimrock. You had Mark Campton on one of your earlier episodes. What an amazing guy. And so anyway, Cornerstone Concrete is another company of ours that we love and is construction/real estate based. We have a few gas stations. So 70-ish% is real estate based. 25% is operating companies is how I would classify it. And then 5 to 10 is like startup tech/startup or some one-off thing that really, quite frankly, Mark was interested in. We said yes, and we see how it goes. So got room in your portfolio for some adventures too.
Yeah. How do you think about the venture stuff? Because from my point of view, I was talking to a friend of mine who works at a venture firm in New York, and I asked him kind of what his first question for looking at a deal is, can this become $1 billion company? Mm-hmm. And my first question when I look at a deal is, what are all the ways that I could potentially lose money from this? And so they call it the barbell approach because they're on two ends of the risk reward spectrum. And I haven't noticed a lot of people who are really good at both of them. How do you think about, your venture portfolio?
Yeah, we're definitely on the other side, meaning we're the side that's how can I lose money?
Yeah.
And so we have not.
How can I not lose
How can I
money?
not lose money? What are the ways for me to lose money? I guess is how I think of what are my downsides. We got involved in the venture stuff, and it's been super fun. And I just see awesome ideas. I think I was telling you, somebody was asking me about all these people that I meet, and I'm like, well, none of the ideas are bad. Nobody thinks of an idea for a business and wants to go monetize it because it's a bad idea. So almost universally, I'm always like really jazzed when I meet with somebody. And I actually hate saying no. It's the worst, but you have to, right? It's part of the job. So, the way we would approach it is, have they done it before? Can it scale? Those type of things. Usually we were trying to find companies that were already into revenue a little bit. A couple feedback items that I've discovered over the past 7-8 years that we've been doing kind of venture stuff has been, be prepared to go in at least a second time, if not a third. Like, that's just the nature of new startups. They're going to need more money, either for good reasons because they're scaling, or for bad reasons because they're faltering, right? And they've encountered one too many hiccups along the road. And you got to decide: are we, doubling down and trying to help them through it, or are we just letting it go and our money's gone? And so, very difficult. So the scale part, I don't know that I think is it $1 billion company because, those are called unicorns for a reason. But
that's why I'm so bad at venture
Yeah.
invest. I will never invest in venture by myself.
Yeah.
I've invested in one fund, and I would be the world's worst venture investor.
So it's been mixed bag. You'd never go into any deal thinking it's going to go bad. That's obviously you're confident. You try to check all your boxes of what you want to happen, what you think is going to happen. But universally, almost immediately, within months of you executing the deal, they have to pivot or they find some new hurdle that's not working. And, that's just the nature of it. And I think there's a timing component. Certainly there's an execution component for the founders that have to go get things done. And again, I think for everybody, there's a little bit of a timing. Is the market ready for whatever you're offering and accepting? But we've had mixed results, in all honesty. And so we had a couple ones go pretty good, quite a few go bad, and it's just mixed bag, and that's kind of how it is. So I was in a conference last summer. I'm going to butcher his name, but Blake Motorzitsky, I think he's the CEO of Paleon. He was presenting, and he was talking about, hey, you get one that gets a 30x, and it covers all these other ones, and it totally got me jazzed. Yeah. I was like, oh man, this is awesome. Like, this is what we've been trying to do, and we have not executed to that point on our venture portfolio, in all honesty.
That's the fund I'm invested in, is Pelion.
Oh, well, good job. Yeah.
I trust them a lot more with my venture portfolio than my own.
One of the funds that we're in is called Epic Ventures, which is based here in downtown. They're awesome. They've been one of our better performers, for sure, our best performer on the overall venture stuff. I just point to the fund, but on our direct deals, we have a few that have been okay. So I still have confidence in we're going to execute.
Speaking of, it feels like you are like Blue Diamond. There are kind of a couple ways to be a family office. You could just allocate passively, or you could be, obviously much more involved like you guys are. How often do you invest in funds? Or is that
very rare? I could name basically all 5 funds that we're in on the podcast here. We were in Seidler Equity Partners out of California, and they were a partner in Mark's phone book company. So we've invested in them as kind of return the favor. Hey, yeah, we're confident in you guys. We're in a Sinosure fund. Uh, that's the
Eccles
Eccles
family.
and we're in Epic. And unless I'm missing one off the top of my head right now. And we're in PEG Development Funds, a couple of their funds. They're one of our main development partners. So if those count as funds, we were always with PEG and historically with PEG in their development deals. But that's the extent of our funds. So it's pretty rare. We really have to have a compelling reason to do the funds. The thing on a family office, if you're an active family office like us, I obviously get paid to work for them. And so they're thinking, hey, I'm paying you to go do the deals and
Yeah.
negotiate the direct deals. I don't want to pay a fund and then kind of pay a double fee, basically, is kind of the thought process. But it's also the excitement. Hey, Mark's an entrepreneur. I want to do direct deals and direct negotiation. And if you are a more passive person, it makes total sense to be in a fund and say, hey, go perform for me and I'll be on the beach.
A common thing that I see from, kind of the bigger family offices is they'll go syndicate because they have the label family office. They are able to attract capital a little bit easier. Do you guys syndicate a lot of your deals? Is it mostly on your own balance sheet? And I guess what are the plans for the future on that?
Yeah, we syndicate quite a lot of deals. Most land deals, take some level of obviously equity, and then you go secure the debt. We've been doing heavy development the past 15 years, mostly through PEG, but through other channels as well. And so I didn't even know that term really when I first got involved at Blue Diamond, syndicate. But basically, hey, if we need 5 million of equity, we're going to do 3 million so that we're the controlling partner, and we'll go let other related parties or existing partners come in to fill in the final 2 million, right? That's syndicating. But so we've done that historically, and deals have got bigger and bigger and bigger, right? The first couple of years, 2013, 2014, a hotel, here locally in Utah or surrounding states was like 20, 25 million to build. Well, now that same hotel is like 50 million to build.
Yeah.
Right? It's just exploded. So, as we've grown the net worth, we've maintained a similar liquidity profile and quite honestly maintained a similar check size as we go to kind of keep deploying and diversifying all the assets. So that's created a situation of, syndicating even more to answer your question. And deals continue to get more expensive and bigger, and you just got to negotiate good terms and, to your point, mitigate the risk. That's, I think, where we come in and are strong is understanding what type of negotiations we can do for terms, and then usually go help our partners kind of take advantage of those same terms.
Can we dig into that a little bit? Like a friend of mine did a syndication with a wealthy individual, and at the time he probably could have got financing at maybe 5.5 or something on a construction loan, not construction to permanent. And his partner got a significantly cheaper, I think it was like 4% or something like that on a construction to permanent loan. And that alone was worth whatever money he was giving them, basically. Yeah. So can we dig into, where do you negotiate? How can you, what do you look for on that?
Great question. I usually look at just the I always try to find out what are the net cash flows of the project or the business. There's all types of fees or cash reserves. If it's a real estate deal, hey, we're going to have a capital expense reserve and a maintenance reserve and debt service. Oh, we're going to have an asset management fee on top of that. Or we're going to have this promote on top of that. I really try to figure out what are the actual cash flows of the business. And once I get down to that level, I can decide what is a good deal for us and what would be a good deal for the sponsor. I want to make them whole, in particular if they execute.
It's nice of you.
Well, and I haven't seen a deal yet where if the sponsor wins, we're not happy, right? I've seen plenty of deals where if the sponsor loses, it means we lose too, and then that's bad for everybody.
Yep.
So there's a fine line of saying, hey, I want our capital to be respected and have some disproportionate share of the cash flows in the early stages, but you go execute and it goes well. We want to pay you. We want you to be rewarded for the deal you put together because that's good for everybody. We're going to be super happy with running our returns. You're going to be happy for getting the promote. So I usually in the concept of a deal, I'll just put in a market rate debt, to be honest. So I don't look strongly at the debt. I'm confident we can go get the debt.
Yep.
And other than saying, hey, we can get the debt for you, and if it needs to be recourse, we'll come negotiate on that as a separate item. Here's what we're going to charge you to be the recourse guarantor on your debt. But that's almost like a separate component of the deal. The key negotiating point to me is the equity splits and the cash flow splits and how that waterfall is going to work. And if that works, great. We have a potential deal in our hands. And if it doesn't, then it's like, all right, sorry, pass and move on.
Talking about the guarantee piece of that, you don't have to use examples of deals that you have done. What do you think is a fair, structure for, let's say I bring you a deal and I say, hey, I have $20 in the bank. I need you to guarantee it for me.
Yeah.
What do you think is fair for that?
Well, that's a great question. To me, I know for us, we're more interested, if we're doing the deal anyway, we believe in the deal, and so we're interested in upside. So to me, more fair is a chunk of the equity on the promote, right? Saying, hey, we think this deal's going to win. That's why we're doing it. That's why we're putting money against it. So we would like to participate in that upside. We're a little bit aggressive on that, right? I've seen plenty of options where it's like, look, man, I'll come guarantee the deal for you, but just here's a fee, build it into your project cost. And so I've seen that fee as low as 1% of the construction or the loan. I think 1% is a little bit low, especially having experience going through a couple of deals that haven't worked and you're performing on the guarantee. And now you're the ones negotiating with the bank of how to work through it.
That fee's high until you're on the other side.
That fee's high until you're on the other side.
Yep.
Yeah. And so I think 1% is low. And that's if you want a cash fee.
Yeah.
Right.
And you're talking 1% without any promote?
Correct.
Okay. Yeah. That does feel cheap.
And so I think that number should be higher. You can't kill the deal so it doesn't pencil, but maybe 3, 4, 5% maybe would make a little bit more sense. But then it's just cash one time and it's out and it's done, compared to you're giving up a little bit of equity on the backside, right? If you give up some equity. But I know for our group, in the deals we've historically done, we're more interested because of the nature that we're doing the deal. We think it's going to win. Okay, well, if we already believe in it and we've agreed to guarantee the loan, we want to get the upside of the equity. So we'll take that risk.
A lot of family offices that I know, they've kind of evolved into more of a private equity structure where historically, when you think of family office, you think, I'm going to get this relatively cheap money for, the next 20 years or something because they hate paying taxes or whatever reason.
Yeah.
But for Blue Diamond, Mark has said he likes to buy these companies or these real estate projects and buy them and sell them in 5 to 7-ish years. How do you think about kind of market timing in that regard? And I guess overall investment strategy?
So
another loaded question for you.
No, it's great. So again, I've been here 10 years, and I haven't seen a deal that we've exited where we really said, "Hey, in 2 years we're exiting this." It's all just been extremely natural. In 2022, we ended up selling out of basically all of our apartments. We just kept getting unsolicited offers. Right, the cap rates were crazy low, and we're like, "Oh, I guess we're accepting this."
Yeah.
And so that's been the situation almost universally every year. Something happens where one of our underlying portfolio projects or companies, somebody comes and says, "Hey, here's a price we want. We're interested for whatever reason to buy the company." So that's been a very natural progression. When we look to get involved, a typical real estate deal, I'll look at like a 10-year pro forma, right? Unless I specifically know that the group is trying to build an exit right on, stabilized lease up or whatever. I'll usually run a 10-year and just, put an exit value on there and pull the discounted cash flows forward. But the reality is we're getting involved and wanting it to cash flow as if we're never going to sell it. My feeling is, as long as you have a performing asset, you always have options, right? You mentioned it earlier. Yep. When you have to have a distressed asset, now you're in trouble. When you're selling a distressed because you have to, that's a problem. You always have options when it's performing. So as long as you can manage it well and make sure it performs, you're going to be fine. And that will yield, though, people coming to you and saying, "Hey, I see you have a great performing asset. I'd like to buy it. I want that performance."
Yeah.
And so that's just been more, again, natural timing of, okay, this makes sense. Sure, we'll accept that offer. It's been I can't think of one where we were like, okay, we're in, and you better be out in 5 years. Like, that's your timeline. That's never been a fixed expectation to any of our partners on the underlying companies.
And how do you think about taxes in that regard? Is it just like I'm making a bunch of money, so...
No, yeah. I mean, taxes are terrible. You try to be as strategic as possible. We certainly go through reviews every year and multiple times throughout the year, and certainly in any given project too, of what does this mean for us tax-wise? Usually it's, hey, we're making money, pay the tax bill, right?
Yeah.
However, that doesn't mean just ignore taxes and kind of pay whatever comes in. We try to be very strategic there's a lot of goings on in the background where we happen to know, hey, deal X is losing, so we can certainly offset that against our gain over here. Enough moving parts that it usually flushes out, but we have a tax bill every year, we pay it, and so we haven't done a crazy amount of, super, certainly not across the line or anything like that. I'm just saying, if we make money on a deal, we'll make money and we'll pay the tax and figure that out.
Cool. You mentioned before the show that you are either getting your RIA or have just gotten it. What does that mean for you? Like, what does an RIA do?
Oh, man.
This is kind of a finance 101 for me.
Okay. So, well, you asked about syndication earlier. And so we will be going through the process to become a registered investment advisor. And basically what that means is, you're basically syndicating deals or raising equity funds for securities purposes. So there's just extra disclosures you got to do, extra paperwork. Everybody we've worked with historically, we've been representing the family office. We've made these direct investments, and if it's a real estate project, and usually we're not the sponsor. So becoming an RIA, I guess, allows us to become the sponsor. You mentioned funds. We could potentially start a fund. I don't think that's really in our game plan, but I think we've done enough work on syndicating deals to realize, hey, this is a step we should probably take to really just follow best practices. I think it's I don't know, I've just been researching it a lot this year. We've had a few sizable deals that we've been looking at, and I've been saying, okay, if we're going to go out and raise funds or raise equity, there's certain check boxes you got to follow, right? And real estate seems to be the wild, wild west. Everybody's just out there. I hear on your podcast and everybody else's podcast, oh, I'm raising all this money. And I'm always kind of thinking in my head, all right, what does that mean? Or what do you have to do? Is that okay? Are you allowed to raise money?
Most of the time it's not I'd screenshot Facebook comments and send them to my friend who's an attorney. And it just gives him a stroke. Like, hey, I'm raising this money for an apartment complex in Louisville, Kentucky, guaranteed 20%.
Yeah.
And I'm like, whoa.
Yeah, you don't want that. You don't want
You
that.
do not want that.
And so, when we've been doing these syndications, I've been kind of like, hey, okay, are we in a different world, or is there anything we need to be doing? Certainly we want to be compliant and do everything the right way and follow the best practices. And yeah, I am. I mean, after all the research I've done so far this year, I've talked to a ton of lawyers, a ton of people, got a ton of feedback, and I'm like, all right, my general takeaway is most people are not following these rules.
No way.
The vast majority probably, but I've come to understand what I think we need to do, and I'm like, this is going to be the best process for us. Yeah, it's going to be a lot of work. Going through the registration stuff. Basically, is just a legal process and some cost, and set up some maybe more enhanced processes and procedures. That kind of is a benefit of maybe being from the Big Four, and I'll comment that the other guys in my office are also ex-Big Four CPAs. So the way we've been able to operate historically as a single-family office has been very extremely nimble, right? And that's still the case for Mark and Debbie within their money and their estate. So we walk in, do you like this deal? Do you want to do it? Yes, done. Go do the paperwork and we'll fund. With the RA type side, it's a little bit more structured and saying, and we've been wanting to do that forever anyway, of, okay, if we want to present something to a bigger group of investors, we want to do it the right way, and we want to have, again, more processes to have, these big guys have these established, decks and processes, and, want to move a little bit, improve on, it's continuous improvement, so just natural progression.
You mentioned kind of the, if you want to call it, investment committee of, getting together with Mark and Debbie and saying, do you want to do this deal?
Yeah.
What are they looking for? Is it like a specific, and I guess how does that actually work? Are you looking at, an IRR calculation? Are you looking at portfolio allocation? Like what metrics do you care about?
Good question. Yeah. So if I see a deal, and I'll go back to my role for a second when you're asking me about like, what do I do? Most new deals, new opportunities in our office, I'm your intro point, your gatekeeper, so to speak. If it's not me, it's Mike Bingham. So it's one of the two of us that's going to meet you for the first time, hear about your business, walk through it.
You were my gatekeeper.
And so I'm your gatekeeper. Yeah,
Yep.
you cold called me. It was great. Good job. And, you know, I've told you this. Sometimes it takes a few plate appearances to
Yep.
to get a deal done. And so, you know, so I'll take that feedback and I try to decide, you know, almost right away, like, does this work for us or not? And if I can tell it doesn't work for us right off the top, you know, I'll let the person know, like, hey, this isn't up our alley. If I do think it could potentially work for us in one of our buckets, then I'll ask some additional questions. I mentioned earlier how I'll usually have them send me their pro forma. I'll kind of recreate it into my own understanding of how the cash flows really work. Do you have a buried acquisition fee in there that's going to yourself? Do you have a buried asset management fee? Or, you know, what type of developer fee are you charging? And I try to carve all that stuff out to understand exactly what the other side's getting out of the deal and what we would be getting at the end of the day on the net cash flows. When I say we, I just mean like the net investor, you know, the sidebar. But so often I see project level IRRs. You know, here's your multiple, here's your IRR. And I'm like, that is a gross IRR on the project without being buried on all the management fees and upfront and promote fees. Like your net IRR is so much lower than that. And I want to get to the net IRR right up front.
Goes from a 20 to a 10 pretty quick.
Very quick. And so that's a kind of a frustration I have. But anyway, I'll do a write-up about the investment, things I like, things I don't like, what the terms on the table are, whether we can negotiate those terms. You know, if we're coming into what I think is a good deal, but they've already raised 90% of the capital and we're kind of going to be a major or minor player, I'll make the comment, hey, we're not in a position to really negotiate here. It's just we can jump in and ride along or not. Or more typical would be, hey, if we write a sizable enough check, we can kind of dictate the terms. Here's what they're looking for, but we can go, you know, kind of propose what we want to do.
And so an example of that is like, let's say I'm offering you a, you know, 50-50 over a 5. And you say, well, we would do it if we brought, you know, 80% or 60% of the equity, but we want maybe an 80-20 over an 8 or something like that. Is that kind of, you're just getting better economics?
Yeah, better economics. Usually it means I'll accelerate the cash flows to say, hey, we want a greater share of the early cash flows to get our money back. Once we have our money back, we're happy, right? We want a return, but generally you're getting your money back, you're going to get the return.
Yeah.
So usually I'll propose something that accelerates the cash flows to the capital investors, right? I'm saying, hey, usually I negotiate kind of for the group, meaning you guys are out there, whoever this sponsor is, proposing a 50-50 split on cash. And I'm saying,
by the way, I don't do that to everybody listening at home. So
that's just a general example.
Yeah.
I'm saying any developer comes in, they propose and it doesn't have to be a developer. This is an operating companies too. Hey, this is the split we're looking for. We want to raise $1 million on a, you know, 10% equity. I'm like, great, I'll take your 10% equity, but the way the cash flows are going to work is actually we're going to take 80% of the cash flows for the first 3 years or until we get our money back.
Interesting.
Something like that. Like, okay, at the end of the day, if I'm only worth 10%, you're going to go prove that I'm worth the 10%. And I'm going to get the majority of the cash flows first. That gets us our money back. Once we have our money back, maybe I'll establish a floor return. Say, hey, we want our cash back plus 8% interest or whatever the number is. Once we clear that hurdle, then maybe I'll agree to your valuation. Maybe I won't. Maybe I'll still adjust it a little bit, but I'm much more likely to do that if I can pull the risk off the table by taking a greater share of the cash flows up front. So I'll put that in my write-up and kind of give my feeling. Obviously, if I don't like the deal, we have 5 people in our investment committee in our company, and it's got to be unanimous. So if I don't like it, why am I bringing it forward, right? Most of the time I like it, though. I'm kind of a sucker that just gets excited about all these deals and loves the idea. I'm like, yeah, this is going to work. And so you bring it in, people start asking about it. I'll send that out to the group before we meet, and we'll talk through them. And it can be several factors. Sometimes it's on our side of the table of just like, hey, you know, here's our capital commitments, and I'm doing that all the time. I do that role right now still. I'll go update the cash forecast and say, here's where I think we're at over the next 6 months based on our inflows, outflows, and forecasts. You know, we have to really like this deal to say yes because our liquidity situation is such that we probably aren't ready to deploy right now. That is a factor for sure, that if, you know, we might see a good deal, but if it's not a great deal or something super awesome, maybe we don't want to stretch our liquidity that much. And we'll end up saying no. And that could be just timing. And that happens all the time. And others are, hey, not for us, not the industry. For whatever reason, we don't like it. Again, almost always it's a good idea, and they end up finding capital in other sources. So most of these ideas are pretty good ideas or projects. But if we don't like the terms, and we can't dictate the terms, another example. So there's a lot of moving parts on that of what makes a deal go and not go. And so it's hard to answer other than long-winded. Sorry.
No, this is I'm having a ball over
Awesome.
here.
Good. Okay.
So, what are you excited about over the next couple of years? I think there's, there were rumors of recessions on the horizon until maybe like last Thursday. Today is December 18th, so we'll see when this podcast comes out.
Yeah.
But, what are you, looking forward to, or what gets you excited over the next couple of years?
Well, a couple things. So heading into 2023, I was super nervous about this year.
Me too.
Yeah. And so we endured. We had a decent year. And so that was, I was like, hey, okay, things can go good. And my general takeaway is if you manage businesses properly and manage them profitably, like I mentioned earlier, you have options, right? So sometimes that means, cutting costs or making adjustments. But you got to manage your business profitably. If you do that, you have options and can be strategic about your go forward. Most of our underlying businesses that we work with did that. That's great. That makes us very happy. They're profitable, and so you can say, hey, we had a good year. Again, not all winners. Have a few stragglers out there, and a couple you were in the middle of the lake, and we're going to figure those out, right, and work through them. So, but on the whole, it was good, and so I guess that makes me optimistic about this coming year. For this coming year in particular, my kind of hitch card is that it's an election year, so I think there was a lot of incentive to have things go well.
Mm-hmm.
So there's rumors on the interest rates kind of settling down and those type of things, and that's probably my take. I'm a little bit nervous about the coming year, but on the whole, I think again, you have good management teams, good groups that you're working with, and if they can manage the businesses properly, interest rates should come down a little bit. I think that'll be a boost. So. And then in general, what gets me excited is just the same thing I mentioned about KPMG earlier. I kind of just know that I'll be dealing with new opportunities, things I hadn't even thought of before. So I mentioned
industrial real estate.
Industrial real estate, absolutely. Yeah. I have a couple deals in the hopper right now that I'm excited about, and 2 years from now, they'll be full on performing or not performing, but hopefully performing, and look back and see what that experience has been. And there's just been several opportunities at Blue Diamond over the 10 years I've been there so far of like, wow, I did not even ever think I'd be exposed to that type of business or industry. And now I've gone through like a whole deal with it and have some type of knowledge. And it's just been really cool to have those experiences. Yeah, it's fun. Yeah. It's fun. It's stressful.
Yes.
Too. When they go bad, it's stressful. But
yep.
On the whole, it keeps you fresh.
I was going to end it there, but I have one more question for you. Okay. You mentioned kind of, obviously you have a lot of winners and you have some losers. Are there any, I guess, commonalities between the losers? Like, are they too bloated? Do they have too much leverage? I guess if you were going to forecast a reason that most companies fail, what would that be? Had to end with a good one.
That's a good question. I'm going to point to failure of management to execute and almost a give up, at least the ones I can point to. And that could be on a real estate project or on some of the operating companies we've had some problems with. Now, a reality is they run out of resources, right? They run out of cash. They're unable to execute to raise new cash or new resources. And some of that's the environment. Market environment changes on you. You're unable to pivot. But I think at the end of the day, it becomes, for the ones that are specifically in my head, it is management just gave up and just thought, I don't know what to do, so I'm just kind of walking.
Really?
And
wow.
That's disappointing.
Yeah.
It's, I guess, a lesson in resilience. You really go through some grueling decision making to try to, save it or not. And that's not the answer for everybody. It's not a universal answer, but for me and the projects that I've been involved in that have gone bad, you got involved in the deal because you were trusting the person to go execute. And again, I always throw in, hey, there's some timing factor, a little bit of luck. It's got to be on your side. Something has to go your way.
Yep.
It's not just, you are not in full control. There's a couple bounces that have to go your way, but you got to be prepared to pick up the bounce and go with it, right? And so,
yep.
But when they're not going your way, you got to endure and grind and figure out something. And the ones I've been involved in that haven't worked out, it's just been, hey, I don't know what to do, and I'm just out. And those have been disappointing, but we've had to grapple with it.
Makes me sad. Yeah,
it does. It's really, and I've been through a couple of them that are long and hard, and and we've been through a couple that we've successfully pulled through. So we have a couple, in our belt of, hey, we were able to turn this around, get it all the way back, and be successful. Now, was that a home run investment? No. Like getting your money back sometimes can be the win.
You uncork
right?
the champagne.
That's right. Yeah, you're pretty happy about just getting the money back. So, it's not that we turned it around and made it a unicorn, but we turned it around, got it to a good spot, got people their money back, got the Binghams their money back on the investment, and we call that a win. But yeah, there's been a couple, and I just have to say, okay, they wouldn't try anymore, and that's hard.
I had so much fun just barely. That was great. Thank you so much, man.
Yeah, thank you. Great time.